What is the key to a winning investment strategy? Bay Street and Wall Street may have you believe that the key is finding a hotshot money manager who has the ability to pick winning stocks before they go up and sell them before they go down, or to be out of the market right before it's about to go down and then jump back in right before it's about to go up. But what if I told you that one of the best long-term investment strategies was less costly, far simpler, and likely to outperform the vast majority of these flashy money managers? In this video, I'm going to talk about active investment management versus passive investment management. We're going to contrast the different styles of investing, traditional active money management, and passive and index investing. And then finally, I'm going to show you how those different strategies have performed relative to one another over long periods of time. And if we haven't met yet, my name is Mark Walhout. I run an investment advisory and financial planning business called Walhout Financial. I help people with retirement, and I created this channel to share ideas and concepts that I'm using to help people with retirement every day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so that you're alerted when new videos are posted. Leave me any questions or comments below. I always love getting questions. It gives me a great opportunity to engage with you, and it also gives me ideas for videos that I can create in the future. So to help illustrate the differences between traditional money management and passive or index investment management, I'm going to share some visuals that I hope will help you as we consider these things. So we'll start with the more conventional or traditional approach to money management. And what you're looking at is a given market. And for the purposes of today's presentation, we're going to talk about the TSX, so the Toronto Stock Exchange, Canadian equities. A traditional money manager or mutual fund manager that's buying and selling stocks in Canada is looking at all the stocks that are available in the market, and they're trying to decide which ones they're going to buy, which are highlighted in green. These are stocks that they believe are undervalued and they think will outperform in the future. The red ones are stocks that the money manager currently owns that they think is going to go down in the near future, so they're going to sell those stocks. And then the gray dots represent equities that are not held in the fund. They're simply either not attractive purchases for that particular money manager, or they're just ignoring those equities for the moment. Now, there's several issues with this approach to money management. First is that it tends to be fairly costly. So Canada still has among the highest fund fees and mutual fund fees in the world. And that is because active management requires a lot of people, a lot of tools, a lot of high-priced resources in order to run a fund like this. The second issue with this style of money management is that it tends to be under-diversified. So you can see in this total market, they only own a very small portion of the total stocks in this market. A typical actively managed fund may own between 40 and 60 individual securities. And in the TSX, there's far, far more securities than 40 or 60. So they may own some of the equities that might perform well in a given year or over a certain time period. But by not owning a whole other bunch of those securities, they may be missing out on high returns that might occur in the securities that they don't own. And then the final issue with this approach to money management is that it tends to be fairly high turnover. And for people that are investing in taxable investment accounts, high turnover can mean taxes or realizing taxes at a time where you do not want to realize those taxes. So that turnover also generates a high amount of taxation in some cases. Now, we'll contrast traditional money management to an index approach. And this is also known as passive investing or using index funds. And using the same market, the Toronto Stock Exchange, let's say that there was an index that was available that allowed you to buy only the largest companies in Canada. And there is an index that allows you to do that. You can buy an ETF that simply tracks the largest 60 stocks in Canada. So the mandate for this fund is simply own the largest 60 stocks in Canada and really do nothing else, just own those stocks. The benefits of this approach, number one, is it's very low cost. It does not require a lot of people resources and tools in order to run an index fund. The second big benefit is that it's highly diversified. If your mandate or if your desire in your portfolio implementation is to have exposure to large Canadian stocks, you're owning a diversified set of all the largest Canadian stocks, so you know that you kind of own all of them. Now you own the ones that are going to do well as well as the ones that are potentially not going to do well, but sort of the metaphor of a rising tide lifts all boats is a useful one here. You're going to get the returns of large cap stocks in Canada by owning all the equities in that basket. And then the final benefit is that it's very low turnover. So there's very, very low turnover in an index fund like this. So you're not seeing a lot of churn in the portfolio for taxable investors index funds or passively managed funds like this tend to be very tax efficient because they're not doing a lot of buying and selling and not churning up taxes when you don't want to. So how do these different strategies compare to one another from a performance standpoint? And to illustrate, we'll talk about the experience of active money managers versus their passive peers in the United States between 2003 and 2022. And what you can see here is that of the 2,855 funds that began the period starting in 2003, by the end of 2022, only 44% of those funds were still even in existence. And of the funds that began that period, only 17% of them outperformed their simple index fund peers. Now we'll look to fixed income and we see the same theme. Of the 1,636 funds that began the period, less than half of them survived until the end of 2022, and only 14% of them outperformed the benchmark. So you might be asking yourself, why? How can this be the case? These are all very bright people. They went to very good schools. They have all the best training. How can they be so poorly performing over long periods of time? And the answer to me really comes down to the market is just very, very difficult to beat. It's a very, very efficient information processing machine. And what I like to talk about is sort of a game of cards or a game of, any type of card game like poker or Crazy Eights. My kids love to play. It's like playing a game of cards with all the cards on the table. It's very, very hard to gain a strategic advantage because all the information that these money managers are trading on is publicly available information. And it's also very rapidly built into the prices of those securities. So what I mean by that is that in 2022 alone, you can see here in the middle of the chart, over $877 billion worth of equities were traded on the market every single day. And with each buy and sell decision, all these parties from around the world, thousands upon thousands of investors, are sort of shaping prices and determining through all their buying and selling activity what they believe as a group is the fair price for that security. So the active money manager who is looking at a security that they want to buy is effectively saying the price of that security is wrong and I'm right and I'm going to go ahead and buy it because I think that it's going to go up in value. And what they're doing when they make that sort of a statement or they take that position is they're saying my particular insight is better than the thousands upon thousands of other people that are actively trading this security every single day. What's the chance that I'm right and those thousands upon thousands and thousands of investors are wrong? Over long periods of time, the answer is it's not a very good chance. And we see that in the data. It's just very hard to beat the market. So we talk about a theory called the efficient market hypothesis. I've mentioned it on this channel before. The market may not be perfectly efficient and prices may not always be perfectly right, but I believe that they are mostly right. And for a long-term investor, I think that it's most prudent to believe or to act as though the market is efficient, even if prices aren't perfectly right all the time. Somebody that's positioned with a portfolio that's primarily held in passive investments, if history is any guide, they're generally going to outperform the vast majority of their friends, neighbors, and peers who are owning actively managed funds for all the reasons that I just discussed. So hopefully this helps illustrate the difference between active management and passive management. I'm a strong believer that markets are mostly efficient and that over long periods of time that people that are owning passive investments or investments that are widely diversified, very low cost, very low turnover, are going to tend to do better than people that own actively managed investments. Now, there's a whole host of resources available on the internet that you can check out to learn more about passive investing. I've included some resources below if you want to learn more on your own and learn more about strategies that you can employ on your own to implement in your portfolios. But hopefully this helps you. This does make a big difference for people that are in retirement. After all, more return in your pocket, less costs paid out by you just means more strength and stability for your long-term investing plan as you move through retirement. So we're going to go back and check out our agenda and see how far we've come in the series and where we're going to go from here. So again, we've talked about objectives, ability, willingness, and need to take risk, asset allocation and the importance. We've talked about my 2-bucket system, stress testing the portfolio, active versus passive management. From here, we're going to go on to big mistakes to avoid in your investment portfolio. And we're going to close the series on advanced strategies. So thanks for watching this video. If you like it, give it a thumbs up. Leave me any questions or comments below and make sure to subscribe to the channel and hit the bell icon so that you're alerted when new videos are posted. Thanks again for watching this video, and I'll speak with you soon. Take care.